You're listening to the Bare Metal Cyber Prepcast, created to help you succeed in your educational journey. Learn more at baremetalcyber.com, where additional prepcasts, books, and training materials await. Let's get started. Online banking has become a central feature of modern finance, offering consumers immediate access to accounts, payments, and services. With this convenience comes heightened responsibility for banks to balance privacy, security, and usability. One of the most significant shifts in this landscape is the adoption of biometric authentication fingerprints, face recognition, and voice prints, which promise stronger protection while reducing friction for users. At the same time, banking applications frequently embed third-party tracking technologies, analytics, and device identifiers to support fraud detection, user experience, and marketing, raising questions about transparency and proportionality. For learners, online banking represents the convergence of multiple privacy themes. It is a domain where sensitive financial data, cutting-edge authentication, and behavioral analytics intersect. Success requires not only strong technical safeguards but also clear disclosures and consumer empowerment to maintain trust in digital financial services. Biometric modalities used in banking extend beyond simple fingerprints. Many institutions now incorporate facial recognition, sometimes using device cameras, and voice print verification, particularly for call center authentication. Each modality offers unique advantages but also carries specific risks. Fingerprints are fast and convenient but can be lifted from surfaces. Facial recognition is user-friendly but vulnerable to spoofing through photos or videos. Voice prints provide a natural experience but may be mimicked with deepfake technology. For learners, this variety illustrates the importance of context in biometric deployment. No modality is universally superior. Instead, institutions must match their choices to operational needs, risk environments, and user expectations while ensuring safeguards against misuse. Enrollment flows for biometrics require explicit consent. Before capturing and storing templates, institutions must clearly explain how biometric data will be used, secured, and retained. This consent must be meaningful, not buried in terms and conditions, and must address whether biometrics are optional or required. For learners, enrollment demonstrates how privacy principles apply in practice. Consent is not a mere formality, but a process that empowers consumers to make informed decisions. It establishes trust by giving individuals agency over whether they participate in biometric programs, and by ensuring that institutions remain accountable for handling highly sensitive identifiers. Liveness detection and anti-spoofing safeguards are crucial to protect biometric systems from presentation attacks. Fraudsters may attempt to trick facial recognition with printed photos, replay audio recordings for voice systems, or replicate fingerprints with synthetic materials. Modern systems employ techniques such as detecting blinking, analyzing 3D facial depth, or monitoring vocal variability. For learners, liveness detection illustrates how security must evolve alongside threats. Biometric identifiers, unlike passwords, cannot be changed easily if compromised. Therefore, proactive defenses against spoofing are not optional. They are necessary to preserve the integrity and reliability of biometric authentication in banking. Secure storage of biometric templates is another core safeguard. Templates should never be stored in plain text. They must be encrypted at rest and during transmission, with keys managed separately and securely. Banks may also employ hashing or tokenization to prevent raw biometric data from being reconstructed. For learners, this area underscores the principle that security and privacy are interdependent. The sensitivity of biometric data demands that it be treated with the same rigor as the most critical financial assets, with layered protections that minimize the chance of exposure even in the event of a breach. Retention limits are equally important. Biometric data should not be held indefinitely, especially after accounts are closed or remain dormant. Institutions must define clear deletion triggers and implement processes to securely purge templates when no longer needed. For learners, this requirement highlights the broader privacy principle of data minimization. Keeping biometric data longer than necessary exposes consumers to unnecessary risk without offering additional benefits. Proper retention policies demonstrate respect for consumer autonomy while reducing the potential fallout from data compromises. Fallback authentication mechanisms ensure that customers who cannot or choose not to use biometrics can still access services securely. For example, a user with an older device may need to rely on strong passwords or multi-factor authentication. The design of fallback options must avoid over-collection of personal data or the creation of weaker pathways for attackers. For learners, fallback mechanisms illustrate the principle of inclusivity in security design. Authentication must be both strong and accessible, ensuring that technological advances do not create barriers for legitimate users while maintaining rigorous standards against fraud. Many banks leverage mobile operating system-based biometrics, such as Apple's Face ID or Android's fingerprint readers, which rely on secure enclaves within devices. These enclaves isolate biometric templates from the broader operating system, reducing exposure to malware or unauthorized access. For learners, this highlights the reliance on ecosystem security. Financial institutions often depend on platform-level safeguards they do not directly control, underscoring the importance of risk assessments, vendor trust, and layered defenses that account for dependencies on mobile operating system integrity. Online banking apps frequently embed third-party software development kits, SDKs, and analytics libraries for crash reporting, performance monitoring, or marketing. While these tools provide valuable insights, they can introduce privacy risks if they collect more data than necessary or transmit sensitive information to third parties. For learners, SDKs illustrate the trade-off between functionality and privacy. Institutions must carefully vet third-party code, ensure contractual safeguards, and monitor data flows to prevent unauthorized access or use of sensitive financial details. Trust in banking apps depends on minimizing hidden data collection that consumers do not expect. Some banking apps employ session replay tools, pixels, or telemetry trackers to study user behavior. While useful for improving design or detecting fraud, these technologies can inadvertently capture sensitive inputs, such as account numbers or balances. For learners, session replay illustrates the risks of overcollection. Regulators increasingly view such practices as invasive if they are not disclosed clearly and proportionately managed. Banking institutions must draw sharp lines between analytics for security and functionality versus marketing or profiling uses that erode consumer trust in sensitive contexts. Cross-context behavioral advertising is especially problematic in online banking. Regulators and consumer advocates consistently emphasize that authenticated banking environments should not be used for targeted advertising based on consumer activity. For learners, this prohibition highlights how privacy expectations shift depending on context. Consumers accept fraud detection monitoring but not cross-selling based on sensitive account details. By prohibiting cross-context advertising, institutions preserve the sanctity of financial interactions and reinforce the trust that banking apps are secure, private spaces. Cookies and device identifiers play a dual role in online banking. They can support fraud detection by linking sessions to known devices, reducing account takeover risks. However, they can also be repurposed for marketing, creating tension with privacy principles. For learners, this dual-use scenario illustrates the importance of governance. Strong policies must distinguish between legitimate security uses and impermissible marketing practices. Consumers should be clearly informed about how cookies and identifiers are used, ensuring alignment between business practices and regulatory expectations. Aggregator access is another evolving area. Historically, fintech apps often use screen scraping, where they logged into bank portals with customer credentials to pull data. This raised significant security risks. The industry is transitioning toward tokenized application programming interfaces, which allow secure, scoped, and revocable access. For learners, this transition reflects the broader move toward open banking. Tokenized APIs balance innovation with security, enabling consumers to use third-party services while minimizing risks of credential exposure or overcollection of financial information. Privacy notices for online banking must address these complex realities, tailoring disclosures to biometric use, third-party tracking, and data sharing practices. Standard privacy notices often fall short, so institutions are expected to provide context-specific explanations that help consumers understand sensitive risks. For learners, this underscores the CFPB's and FTC's emphasis on clarity and prominence in financial privacy disclosures. Transparency builds trust and supports informed choices, particularly when banking apps combine cutting-edge technologies with sensitive personal data. Finally, user preference centers are becoming a best practice. These tools allow customers to manage settings for data sharing, marketing, analytics, and even biometric enrollment. For learners, preference centers embody the principle of consumer empowerment. Rather than burying controls deep in terms or requiring difficult opt-out processes, institutions provide accessible dashboards where users can exercise meaningful control. This not only satisfies regulatory expectations but also fosters loyalty by demonstrating respect for consumer autonomy in the digital banking experience. For more cyber-related content and books, please check out cyberauthor.me. Also, there are other prepcasts on cybersecurity and more at baremetalcyber.com. Strong authentication practices are foundational to online banking security, and multi-factor authentication has become the industry norm. Risk-based authentication further strengthens this framework by adapting requirements to transaction context. For routine, low-value activity, standard authentication may suffice, while high-risk transactions, such as international wire transfers, can trigger additional verification layers. For learners, this demonstrates how modern banking balances usability with risk. Adaptive approaches ensure that legitimate customers are not overburdened, yet attackers face escalating hurdles when attempting fraudulent actions. Device binding, certificate pinning, and secure session management are also critical defenses. Device binding links an account to a known device, while certificate pinning ensures that apps only trust communications with authorized servers. Secure session management involves expiring inactive sessions, encrypting tokens, and monitoring for anomalies. For learners, these controls illustrate how the invisible plumbing of online banking supports trust. By safeguarding connections and managing devices carefully, institutions reduce exposure to man-in-the-middle attacks or session hijacking, protecting the integrity of financial transactions. Behavioral biometrics add another layer of anomaly detection. These techniques monitor how users type, swipe, or navigate, establishing unique behavioral patterns that can reveal impersonation attempts. Importantly, privacy expectations demand minimization, meaning institutions should collect only necessary metrics without overreaching into unrelated behaviors. For learners, behavioral biometrics highlight innovation in fraud detection that must be tempered by restraint. These methods are powerful, but they must operate within clear privacy boundaries to maintain legitimacy and consumer trust. Transaction monitoring is a long-standing but evolving safeguard. Modern systems analyze payment velocity, location mismatches, and changes in recipient details to identify outliers. For example, a sudden transfer to a new overseas account may be flagged for review. For learners, transaction monitoring illustrates the dynamic nature of fraud prevention. Threats continually shift, so monitoring must adapt, drawing on analytics and historical behavior to distinguish legitimate from fraudulent actions without overwhelming customers with false positives. Cryptographic protections remain at the heart of online banking security. Institutions must encrypt sensitive data, both at rest and in transit across web and mobile channels. This includes end-to-end encryption for mobile banking sessions, strong key management practices, and regular rotation of cryptographic keys. For learners, cryptography underscores the technical backbone of trust. Consumers may never see these processes, but they are fundamental to ensuring that financial data is not exposed to interception or tampering. Phishing, smishing, and push fatigue attacks remain among the most effective tools for fraudsters. Banks combat them with layered verification, such as requiring additional confirmation for sensitive actions, educating consumers about scams, and deploying detection systems to identify fraudulent domains. For learners, these defenses highlight the social engineering dimension of banking security. Even the strongest technical controls can be undermined if users are tricked into surrendering credentials. Education and layered defenses combine to close these gaps, recognizing that fraud prevention requires both technology and awareness. Account recovery and secure enrollment are also vulnerable points. Fraudsters often exploit weak recovery processes to reset credentials and take over accounts. Banks must implement robust verification, sometimes requiring out-of-band confirmation or in-person checks. For learners, account recovery demonstrates that security must extend to the edges of the user lifecycle. A system is only as strong as its weakest link, and recovery processes often represent that link if not carefully designed. Vulnerability management, secure development practices, and mobile app hardening standards ensure that banking systems resist exploitation. This includes timely patching of software, code reviews, penetration testing, and obfuscation of app code to prevent reverse engineering. For learners, these practices reflect the discipline of secure engineering. They remind us that compliance is not only about policies, but about technical excellence and continuous improvement. A secure mobile app is not a one-time project, but an ongoing commitment to resilience. Cloud architecture brings both opportunities and challenges. Many banks leverage cloud services for scalability and innovation, but they must implement segregation of workloads, strict access controls, and secure logging practices. Sensitive financial data requires dedicated protections, ensuring it is not commingled with less secure workloads. For learners, this illustrates how cloud adoption must be carefully managed. Regulators expect financial institutions to demonstrate control over where and how customer data is processed, even when infrastructure is outsourced. Third-party risk assessments are vital for fintech partnerships and embedded finance integrations. Banks often collaborate with startups or integrate third-party services, creating new privacy and security exposures. Institutions must conduct due diligence, monitor vendor practices, and require contractual commitments to privacy and security standards. For learners, vendor oversight highlights the interconnected nature of financial ecosystems. Trust in online banking is collective, not individual, and institutions are held accountable for ensuring partners uphold equivalent standards. Incident response planning and breach notification are essential in today's threat landscape. Banks must coordinate with processors, vendors, and regulators to detect, contain, and disclose incidents involving sensitive information. For learners, incident response illustrates the inevitability of security events. The measure of resilience lies not in avoiding all breaches, but in handling them swiftly, transparently, and effectively. Consumers expect institutions to communicate clearly, provide remediation, and strengthen safeguards in response to incidents. Records retention for logs and telemetry must be carefully managed. While logs are critical for monitoring, detection, and forensic investigation, they also contain sensitive details. Institutions must enforce strict access controls, minimize retention to what is necessary, and protect records through encryption. For learners, this demonstrates the balance between operational need and privacy. Retaining data too long increases risk, while retaining too little hampers investigations. Thoughtful governance ensures both security and accountability. Transparency in customer communications remains vital. Institutions must inform users about how biometric data is handled, whether third-party trackers are embedded, and what choices they have regarding analytics and marketing. These disclosures must be clear, conspicuous, and accessible, reinforcing trust in online banking platforms. For learners, communication illustrates the theme that trust is built not only through technical defenses, but also through honesty. Clear explanations of practices enable consumers to make informed choices and feel confident in using digital banking services. Finally, metrics and audits are necessary to demonstrate the effectiveness of online banking controls. Institutions must monitor outcomes such as fraud detection rates, false positives, incident response times, and customer complaints. Independent audits validate that controls are operating as intended and provide evidence to regulators. For learners, metrics reinforce the principle of continuous improvement. Security and privacy are never finished. They must be measured, evaluated, and refined over time to adapt to evolving risks and maintain consumer trust. In conclusion, online banking privacy and security require a blend of strong authentication, careful tracking governance, and transparent disclosures. Biometric authentication, behavioral monitoring, and cryptography provide technical safeguards, while vendor oversight, training, and communication create organizational resilience. For learners, the enduring lesson is that trust in digital financial services depends on a comprehensive approach. Security, privacy, and transparency must be integrated into design and operations, ensuring that online banking remains both safe and user-friendly in a rapidly evolving digital economy. Thanks for tuning in to the Bare Metal Cyber Prepcast, your trusted source for cybersecurity news and insights. Remember to subscribe at baremetalcyber.com so you never miss an update. And visit cyberauthor.me for best-selling cybersecurity books that equip you with expert knowledge. Until next time, stay secure and stay vigilant.